Here's a question that trips up millions of everyday investors. Should you put your money into an ETF or a mutual fund? They sound similar. They both hold baskets of stocks or bonds, and yet the differences between them can add up to thousands of dollars over your investing lifetime. Today we're going to break this down clearly, with real numbers and zero jargon overload. By the end of this video, you'll know exactly which one fits your situation. Let's get into it. Let's start with the classic, mutual funds. A mutual fund pools money from thousands of investors and uses it to buy a collection of stocks, bonds, or other assets. A professional portfolio manager, or a team of them, decides what to buy and sell. Here's something important to know. Mutual funds are priced just once per day, after the stock market closes at 4 p.m. Eastern. So if you place an order at 10 a.m., you won't know your exact price until the end of the day. Many mutual funds also require a minimum initial investment, often between $1,000 and $3,000, though some are lower. Now, let's talk about ETFs, exchange-traded funds. Think of an ETF as a mutual fund that trades on a stock exchange the same way a share of Apple or Google does. You can buy or sell an ETF at any point during the trading day at whatever the current market price is. Most ETFs are passively managed, meaning they simply track an index like the S&P 500, rather than having a manager pick stocks. And here's a big deal for new investors. Many ETFs have no minimum investment. If a single share costs $50, that's all you need to get started. Brokerages like Fidelity and Charles Schwab even offer fractional shares. Here's where it gets really important. Costs. Every fund charges an expense ratio, which is the annual fee you pay just for owning the fund. It's expressed as a percentage of your investment, and it's quietly deducted from your returns every year. Actively managed mutual funds, where a manager is picking stocks, typically charge between 0.5% and 1.5% annually. That might sound small, but on a $100,000 portfolio, 1% is $1,000 every single year. Index mutual funds and index ETFs are much cheaper, often as low as 0.03%. The Vanguard S&P 500 ETF, ticker VOO, charges just 0.03%. That's $3 a year on a $10,000 investment. Costs compound just like returns do, only in the wrong direction. Let me show you exactly what that cost difference looks like over time, because this is where the numbers get eye-opening. Let's say two investors each start with $10,000 and earn the same 7% annual return before fees. Investor A is in a mutual fund charging 1% per year. Investor B is in an ETF charging 0.05%. After 30 years, Investor A ends up with roughly $57,000. Investor B, nearly $74,000. That's a $17,000 difference, just from the fee gap. This is the real power of low-cost investing. The data is clear. Every dollar you save in fees is a dollar that stays in your portfolio compounding for decades. Here's a statistic that should make you think twice about paying extra for active management. According to the Spiva scorecard, one of the most respected studies in the industry, 87% of actively managed large-cap U.S. stock funds underperformed the S&P 500 index over a 15-year period as of 2023. That means the vast majority of professional stock pickers, who charge you higher fees, still couldn't beat a simple index fund that just tracks the market. This is one of the most powerful arguments for low-cost index ETFs and why they've exploded in popularity over the past 2 decades. This is for educational purposes only, but the data speaks for itself. Now here's a difference that most beginners overlook entirely. Taxes. When you own a mutual fund in a taxable brokerage account, the fund manager might sell positions during the year to rebalance or meet redemptions from other investors. When that happens, capital gains get distributed to all shareholders, including you, even if you never sold a single share. You could owe taxes on gains you didn't even realize. ETFs handle this very differently through a mechanism called in-kind redemptions, which allows them to swap shares with large institutional investors without triggering a taxable event. The result? ETFs are generally far more tax efficient. This matters most in taxable accounts. Inside a 401k or IRA, taxes are deferred anyway, so this advantage shrinks. Here's a practical reality check. If you're investing through your employer's 401k, you probably don't get to choose ETFs at all. Most 401k plans offer a menu of mutual funds, often index mutual funds, and that's it. The good news is that many 401k plans today offer low-cost index mutual funds with expense ratios under 0.10%, so you're still in good shape. In an IRA or Roth IRA that you open yourself at a brokerage like Fidelity, Vanguard, or Schwab, you typically have access to both. And in a regular taxable brokerage account, ETFs often make more sense because of that tax efficiency advantage we just talked about. Know which account you're dealing with before you decide. Let's look at the key features side by side in a visual comparison. We're scoring each category from 1 to 10 for both ETFs and index mutual funds, covering cost efficiency, tax efficiency, trading flexibility, ease of automatic investing, and minimum investment accessibility. As you can see, ETFs score higher on costs, taxes, and flexibility, while index mutual funds have a slight edge in automatic investment plans. Things like automatic dollar cost averaging, where many brokerages let you set up recurring purchases without any friction. Neither is perfect in every dimension, but together, this picture helps clarify when each one shines. The market has been voting loudly with its dollars. ETF assets under management in the United States have grown dramatically over the past decade, surpassing $8 trillion as of recent data. Meanwhile, actively managed mutual fund flows have been mostly negative, meaning more money is flowing out than in. Investors are catching on to the cost and tax advantages we've discussed. According to investment company Institute data, passive index strategies, largely through ETFs, now represent a major and growing share of total U.S. fund assets. This shift isn't a fad. It reflects a fundamental change in how Americans are approaching long-term investing. Now, let's be fair. Mutual funds absolutely still have a place in smart portfolios. If your 401k plan only offers mutual funds, you work with what you've got. And if those are low-cost index mutual funds, like a Fidelity or Vanguard total market fund, you're honestly not giving up much compared to ETFs. Mutual funds also tend to be easier for automatic investing. Many plans let you say, invest $200 every paycheck, and it just happens, down to the penny. ETFs require buying whole shares, or fractional shares at brokerages that support them, which can be slightly less seamless. Some specialized strategies like certain actively managed bond funds also remain easier to access via mutual funds. The point is, don't let perfection be the enemy of good. All right, let's make this actionable. Here's a simple decision framework. First, what account are you investing in? If it's a 401k, look at what's available and pick the lowest expense ratio index fund on the menu. Typically, that's something tracking the S&P 500 or the total U.S. stock market. Second, if you're in an IRA or a taxable brokerage account, ETFs like VOO, VTI, or SCHB are excellent starting points to research. They're low-cost, broadly diversified, and tax-efficient. Third, always check the expense ratio before you buy anything. And fourth, remember this above everything else. Staying consistent with your contributions matters far more than which vehicle you use. A mutual fund investor who contributes every single month will almost always beat an ETF investor who contributes sporadically. Want to see the real goal here? If you invest just $500 a month, that's about $16 a day, for 30 years, and you historically average a 7% annual return, you end up with over $1 million. That's roughly $180,000 of your own money and nearly $900,000 in investment growth. Whether you get there through ETFs or mutual funds matters far less than whether you actually start and stay consistent. The vehicle matters, the costs matter. But the behavior, the habit of regular investing, is the true engine of wealth. All investments carry risk, and past performance doesn't guarantee future results. But the math of compounding is relentlessly on your side the earlier you start. Let's bring it all together. ETFs and mutual funds are both legitimate tools for building long-term wealth. ETFs generally have the edge in costs, tax efficiency, and trading flexibility, especially in taxable accounts. Mutual funds remain dominant in 401k plans and are perfectly fine when they're low-cost index funds. The single most important number to look at is the expense ratio. That's your annual fee. Keep it as low as possible. And whether you're 25 and just getting started or 50 and catching up, the principle is the same. Invest consistently, diversify broadly, and let compound growth do the heavy lifting. Consider speaking with a licensed financial advisor about what strategy makes sense for your specific situation. Before you go, everything in this video is for educational purposes only and does not constitute personalized financial advice. Always consult a licensed financial advisor before making investment decisions. Past performance does not guarantee future results, and all investments carry risk, including the possible loss of principal. Thanks for watching US Wealth Logic. Subscribe for more data-driven financial content every week.